first idea, Linamar.
Yes, Linamar is actually, you wouldn't know it by its share price in recent weeks, but they're actually having an all right year, and largely because their industrial segment is doing very well. And that segment includes the Skyjack aerial lift business and also their agricultural equipment business as well. Mm-hmm. And that's masking an underperforming auto parts division. And so the opportunity here is that the Skyjack aerial lift business is expected to continue to do very well next year as well, based on the order backlogs of the industry, with Terex and Oshkosh being two of the biggest competitors, right? And Terex being the maker of the Genie aerial lifts. And Skyjack also expects, the other two competitors expect they might have to start raising some prices next year, even though their backlogs are looking good. And Skyjack figures they can keep prices constant. And that's probably because they're domiciled in Canada, where they take advantage of the weaker Canadian dollar. Mm-hmm. And so the opportunity here with the industrial business expected to do well next year, all you need on the auto parts side is just an improvement off the bottom. I mean, if they can go from underperforming just to average, that'll be enough of a lift in earnings to increase the earnings per share, and considering the low valuation and the stock being near a 52-week low, it'll likely have a lift on the share price.
Okay, so yes, your argument is that the farm equipment, the industrial is okay. The auto parts, once that turns around, it'll lift the stock.
Yes, and yeah, the industrial is doing very well. And so, and people think that, well, the company's doing okay, but the auto parts is not doing very well at all, and it's underperforming, and there's room for improvement. Mm-hmm. Yeah, and that just improving to getting from underperforming to average, that'll be enough of an improvement to likely lift the stock.
TC Energy, 7.2% yield on this stock.
That's a wonderful yield, and the outlook for this company, including the dividend yield, is attractive as well. And there's a few reasons for it. I mean, they just recently increased their profit guidance for this year from a 5 to 7% range for EBITDA growth to 8% for the year. They've also expressed confidence in being able to reduce their debt levels to more respectable levels by the end of next year. And then the third point is that they reiterated their dividend growth of 3 to 5% annually. And so you mentioned how they're at a 7.2% dividend yield. If you've got a company paying 7% and they're able to grow their dividends 3 to 5% per year, I mean, all things being equal, that's a 10 to 12% total return growth profile owning a durable pipeline stock. All right. And then, of course, if we have rate cuts occurring next year, that has a general lift on high dividend payers, such as pipelines, and that could also benefit TC Energy.
Okay, and then your next idea, TD Bank has had a frustrating year. A U.S. acquisition couldn't go ahead, it seems.
That as well, yes. And then they I guess they kind of disappointed the market just recently with their fourth quarter results announcement. I mean, all the banks, they have their fiscal year end October 31st. And so in the last quarter of the year, they typically bury a lot of their charges, restructuring charges into the last quarter, so they can set themselves up for a cleaner new year. Mm-hmm. And all the banks did that, except for TD Bank. And TD Bank did announce restructuring charges for the fourth quarter, but they were the only bank that announced charges or expenses for the upcoming year, $500 million worth of expenditures on risk management and anti-money laundering controls. And so that put a damper on it. And so while Royal Bank, CIBC, BMO, and National Bank all saw their stock prices jump, TD Bank did not. And so I believe it's just basically, it'll be a delayed response. I mean, these expenses that they'll be incurring this coming up year, once that's in the rearview mirror, then TD Bank stock will be able to catch up to its peers. And then you earn almost a 5% dividend in the meantime.
Do you think this will tangle with the regulators in the States? We don't know all the details, but they weren't happy, apparently, with some of the controls, the money laundering controls.
That's right.
That's what we've heard. I don't know how much the bank has revealed. Is that going to hang over TD Bank, though?
Well, yeah, you're right. It's the Department of Justice which spurred these expenditures for the upcoming year, $500 million. And so,
sorry, what do you mean? Do they pay a fine or settlement?
No, I don't. They were basically, I guess, there was an expectation that they had to beef up their
I
controls.
see. Sorry, yeah, okay.
And I don't know if there was a compliance review or an audit, but it was the Department of Justice that sort of spurred that. And so, And so, yeah, you're right. I mean, it puts a bit of a cloud. I mean, just the fact that they're going to have to spend $500 million on this stuff next year, while all the other banks are seeing improvements in their expense growth, it set them back. But it is of a one-time nature, and so whenever you have a successful bank that with a good long-term track record that has a bit of a hiccup, I think it's a buying opportunity.
Remember that thing years ago with HSBC? Apparently, they changed the size of the teller windows so the drug dealers could push their huge bags of cash through. I don't know if that was ever. That's what's said to have happened. Anyway, yeah. Anyway, so that was a legendary bit of money laundering from HSBC.
Yeah, no, the controls are quite tight. If you're working in the financial service industry, there's a lot of increasing compliance.
Well, it's what fuels crime and corruption around the world, money laundering. So it is good.
Yeah. So TD they'll be very tight on that. At least they're not in the situation of Wells Fargo, where Wells Fargo has had a consent order by the Federal Reserve since 2018 to clean up their governance, their compliance, and their risk management.
Oof.
And the Federal Reserve capped their assets at $2 trillion. And they're not allowed to go over there until they fix that. And they've been working at it for 5 years. And the CEO last year said it might take several more years. So it's either they're taking their time, doing it very, very slowly, or there's a real mess that they're cleaning up.
First idea, somewhat contrarian, Franco-Nevada. It's been suffering because they have that big stake in the Cobre Panama mine, or a big investment there.
Again, this gets to it doesn't get to arithmetic. It gets to history. This is, from my point of view, the finest gold miner in the world. The management expense ratio is infinitesimal. They've done a wonderful historic job. They are, in fact, penalized, of course, by the Cobre Panama decision in Panama. It's worthy to note that an asset that comprises 15% of net asset value has caused the stock to come off by 35%. So I think the arithmetic is overdone, first of all. Mm-hmm. The second thing, however, is that I'm betting that the decision in Panama needs to be reversed. The Panamanians have decided to shut down a deposit that's over 5% of GDP, over 25% of their export earnings, and will cause the nation to face a claim in arbitration for damages that exceed $10 billion US. It's very seldom that you get a chance to buy Franco-Nevada at a fair price. This is a fair price for an absolutely great company. Great big deposits of the type that Franco-Nevada has royalties on almost always yield you surprises over time. And those surprises, with the exception of political surprises, are almost always good. I think, too, it's important, Andrew, to understand that in the last 6 or 7 years, I've graded almost 80,000 individual portfolios for free. And I've noticed that most gold investors in particular are much too speculative. In a gold bull market, you get spectacular moves just out of beta, which is to say the extent to which the gold equities outperform major markets. And so many, many, many people who invest or speculate in gold and silver stocks have portfolios that are way too speculative for their means. Buying companies like Franco-Nevada, tying yourself to a major move in the market, which I believe is coming, becomes an intelligent strategy. Buying the best company in the business after a temporary setback is a wonderful opportunity.
Let's get on to your next idea. Exxon Mobil. For quite a while, it was out of favor with investors, but Exxon likes to do things its own way. It's stuck to the dividend, for example.
I believe that the whole oil and gas sector is going to do well, and I think that the best asset allocator in the sector is Exxon Mobil. It was punished some years ago by getting kicked out of the Dow Index. That can only happen once. But what we see is that Exxon Mobil has a wonderful, wonderful, wonderful basic business. You can see that they've doubled down in the Permian Basin with their recent acquisition of Pioneer, which, by the way, has been a weight on the stock. It's also amazing that the exploration successes that they have enjoyed in Guyana, admittedly a troubled political circumstances, have added 11 billion barrels in recoverable reserves. An exploration result that can move even a great big company like that. Exxon has been able to maintain their sustaining capital investments in an industry where the whole industry as a whole has been deferring sustaining capital investments, which means that the rest of the industry will experience lower production in the out years while Exxon will maintain theirs. And they have decided to increase the returns to shareholders via stock buybacks and dividends by 14% going forward. wonderful investment grade company belongs in every portfolio that has a 5 to 10 year outlook, every single portfolio.
And your final idea, Sprott, trades in New York, for example. SII also trades in Toronto.
Disclosure of conflict. I'm a former officer, former director, former employer of Sprott. I am still, I believe, the largest individual shareholder in Sprott. I believe two things. The basic business in Sprott, which is asset management around natural resources, is a very good business, and it's a particularly good business at Sprott. Assets under management when I joined Sprott in 2011 were about $3 billion. Assets under management in exchange-traded products at Sprott now exceed $25 billion in U.S. dollar terms. Cash-generating capability at Sprott continues to improve. The net debt has been effectively eliminated. Sprott needs to decide what to do with the money. Do they use it for an acquisition? The balance sheet is in very good shape. Do they increase it to shareholders? But Sprott is more than that. Sprott is a brand name for precious metals and natural resource investing. If I'm right about the fact that we have a precious metals and natural resources bull market over the next 5 years, first of all, the assets under management at Sprott will increase much faster than the general administrative charges. But secondly, the multiple around Sprott, given the fact that it's a brand name, will increase. At some point in time, if I am correct about a resurgence in natural resources relative to other asset classes, I think Sprott will be a wonderful takeover for one of the very large financial supermarkets. Say a UBS, say a BlackRock, say a Manulife. I'm not saying it's going to occur, but if I'm right about the direction of natural resources, the very brand of Sprott will have value in addition to the wonderful asset management business that it enjoys. Meanwhile, you get paid a very handsome dividend while you wait.
Yes, I see you, according to the latest filing cited by Bloomberg, you had just over 10% of Sprott and the yield about 3.2%. Rick, we could, as I say this to every guest, but I really mean it when it comes to you, we could talk to you all day. And thank you very much indeed for joining us.
Well, Andrew, I look forward to joining you again. Thank you very much for having me on.
Thanks, and have a great holiday and a wonderful 2024. I know you are going to. Rick Rule of Rule Investment Media. First idea here is CGI. Now, we talked already about Constellation Software, and in some ways a similar big IT services provider.
Yeah, so I mean, this is a really unique business. So it's, global IT. Outsourcing and consulting. So it's a pure service business, and really, really well run. Global footprint, and I think in terms of the big trends that really help CGI is trends towards really digitization. And then also with higher labor costs, people are looking to technology to get more efficient. And I think this plays right into CGI's playbook. And I think if you look at this business over the long term, very good at allocating capital and doing acquisitions, very durable business. And if you look at the valuation, around 18 times earnings, you don't get a dividend with this one, but they have so much flexibility to create value. They can do acquisitions, they can buy back shares, they can put it towards organic initiatives. So I think this is one that's growth at a reasonable price. This is a good GARP idea.
Yeah, it's. I'm just doing IT services smackdown here between Constellation and CGI. CGI's done well, but Bloomberg indicates you've had a return of 68% in 5 years, whereas Constellation almost 300%.
Yeah, so I think even with that comparison is not fair. I'm pretty sure Constellation is the best compounding. It's one of the best compounders ever created.
Okay.
In terms of what they do is so difficult for other people to do because they acquire very, very small software companies.
Right.
And then they buy them for very inexpensive valuations, and then the cash just keeps flowing, and they keep that going. And then, CGI. It'd be tough for them to compete with that, but I think it's tough for anyone to compete with Constellation. Mm-hmm. Like I'm fairly certain over the longer, if you look at 15, 20 years, it's the best compounder in Canada by a long margin, and it would be up there in the world as one of the best compounders.
Yeah, The Economist magazine a few days ago said it's the world's best acquirer of tech companies.
Fair
Constellation. Enbridge, as advertised, why do you like this one?
Yeah, so this is one that I alluded to a little bit earlier. I always like to have one for income-seeking investors, and so this is my kind of income pick. What I really like about it is, in a tough environment, when companies were retrenching, Enbridge was able to do an acquisition. And I think this is a wonderfully well-run company, very, very defensive cash flows. They're kind of transitioning their business mix to get a little bit more diversified, and it's dirt cheap. This is a business that's 8 times cash flow, dividend yield almost 8%. And this is part of it. Like, people do not like oil, or they don't like energy, and so this one kind of gets thrown out. But in terms of a durable, defensive business model that pays you a wonderful dividend yield to wait, and has been aggressive in a tough environment, it does all the things you want if you're an income investor.
And finally, Yum China would be one of your favorite fast food ideas.
Yeah, so this is one, this is an emerging market equity. And I think what's really unique about Yum China, this was spun off by Yum Brands. So this is, a pure play Chinese company with Western governance. So, the balance sheet is pristine. They've got more than $3 billion in cash, a really, really strong management team that's accelerating their store build out. And they've got an amazing digital capabilities for their business. So I think, this is one, like you see on that chart, it's been, recently kind of fallen back down. So I think the valuation there is amazing. So I think this is one, even if you heard earlier this week about, McDonald's and Starbucks and their plans to grow in China, you can get a pure access to the growth in China. And if you look at the valuation between Yum China and Yum Brands, it's almost a 7.5 multiple point difference.
Cheaper for the Chinese one.
It is, because of the sentiment towards China. But there's way less potential for the government to intervene or to try to constrain growth. So it's a lower risk way to play the exceptional growth in China.
Yeah, but it doesn't involve sensitive things like chips and military equipment.
And data, and
You don't get the military weaponizing chicken, I suppose, yeah. We better leave it there, Chris. Thank you very much indeed. And if we don't talk to you again this year, have a great holiday.
You too. Thanks for having me.
First idea, Elevance Health, the giant insurer.
Yeah, all 3 of the top picks today, Andy, are in areas that are companies that have been out of favor in 2023. And I thought it was a good idea to start, or end rather, the year with where we think the rotation might take us. And healthcare is one of those areas. We've had a great year at Goodread. We've done extremely well on behalf of our clients. We're very happy about that, but you can't rest on your laurels. You've got to look into the future and where the values rest. So we think that healthcare is a big opportunity. It's really done nothing. I mean, Elevance is an example of that. The stock is flat for the last 2 years. Yet if you look at the earnings per share, they're up 27% over the last 2 years. So, which means it's trading at a lower and lower valuation, about 15 times this year, and about 13.5 times next year, I think. So very good company. Management is behind the estimates of double-digit growth of revenue and about 15% annual growth of earnings. So we just think the healthcare in general, but the insurers in particular are really ripe for a rebound. And we're an owner of Elevance.
Okay. Merck and Company, the drug giant, what attracts you here in particular?
Well, they're not only their portfolio, which is being led by Keytruda, a fantastic cancer-fighting drug. We saw this morning that Moderna came out with a study that showed that in concert with their drug, Keytruda was very, very effective in fighting melanoma, and huge advance. So Keytruda in itself is being very effective, but they're finding that in concert with other drugs, it's got more and more applicability. Keytruda, the biggest drug by market share in the world.
Wow.
Their other big drug is Gardasil, which is their HPV vaccine. So this is a company with a great portfolio, but also a great pipeline. In concert with that, it's a low valuation company, trading at about 12 times earnings, AAA balance sheet, good future. We think this is ripe for good times ahead.
Okay. Yeah, apparently part of the Keytruda mechanism is the cancer cells use a PD-1 pathway to hide from the T cells, the immune cells.
Yeah.
And Keytruda blocks them from using that particular sly trick.
Yeah, it's,
Incredible.
the opportunity that it presents itself, and I know we've talked a lot about AI, but AI as it applies to scientific research and in particular drug development is going to be life-changing.
Yeah.
And bring it on.
Yeah, that's right. They do know that it can cause your immune system to attack normal organs and tissues, but of course that's true of traditional cancer remedies.
Exactly.
RTX is your final idea.
Yeah, not of course in the healthcare area. This is an industrial, the old United Technologies, and they've had their troubles in 2023. They discovered that there was a contaminant in some of the components that they put into blade fans in their engine turbines, which it's not a safety issue, but it's certainly an issue that has to be addressed. And it's costing them about $5 billion to take engines off, check them, retrofit them, and so on. Now, it sounds like it is a big number, but it's in context, not something that's going to derail this company. We've seen about a 20% adjustment in their stock price. They're solving the problem. Their business is growing, other than that, very, very sharply. The biggest backlog in their history at about $160 billion. They're trading at a lower valuation than they would have because of this issue. And our experience, my experience has been that when you have problems that you think can be solved with time and effort, that the shock to the value of the stock will dissipate over time as confidence builds. And investors should take advantage of that. And we think that RTX is presenting investors with exactly that opportunity.
Gord, we better leave it there. Thank you very much indeed.
Thank you, Andy. All the best of the season to you and to all our viewers.
Same to you. First idea, Franco-Nevada. This one out of favor, of course, because people fear they could take a bath on Panama.
Yeah, so this is a company that we've wanted to get into for a long period of time. One of my colleagues, Ryan, he's been a big champion of this. But in effect, what we see is the forced closure of the mine through Panama is you've got an economic value that the market's effectively ascribing zero. There will be international arbitration. There will be layoffs in the mine. There's, I think, 7,000 layoffs in the country. And then Panama obviously has elections next year. So there's going to be some issues here. And ultimately, there will be some value monetized. But what that sell-off has done is given us an entry level that we're quite happy with. The company has no debt and is the buyer of last resort, or the funder of last resort for mining companies when you have a recession. So I think this is a very good entry level, but this is the kind of company that you want to hold for a long period of time. If you look at the long-term chart, this is actually one that is a structural grower. So we like it. We think there's some longer-term opportunity, and if this has a little bit more downside, not too worried. But between now and year-end, tax loss sellers are probably going to hit it. I think it was up about 150 yesterday, but our entry level was even lower than that. So I think from this point moving forward, this was just one you put away and you leave and you check on it periodically, see how it's going to do.
Yeah, I don't know how much, I haven't seen any research indicating whether the market still attributes any value to the Panama mine.
Nada.
Yeah.
Nada.
So, yeah, we know that First Quantum has tanked as well. Royal Bank of Canada is your next idea. Why do you like this one?
Okay, so it's a while since I talked about a financial, so I thought it was time to discuss a financial. Good franchise, good risk management, diversified operations. I think that I'm in the view that interest rates aren't going to go down as quick as people expect. So I think the higher interest rates are going to be obviously supportive from an earnings point of view. And I think the challenge is going to be whether or not we see big credit losses. And I think the central bank will step in and smooth some of that. So I think it's a great franchise. I think the stock is the total return in the last few years relative to the 10-year return is down significantly. I think 3.7 versus the better part of 11. So if you're looking at a total return normalizing over time, then there's significant upside from here. But good franchise, all the Canadian viewers obviously know it, and it's one that we hold and we continue to like.
So, sorry, what did you say about the 10-year return from Royal Bank?
So the total return in the last 5 years has only been 3.7, where the 10-year return is closer to 11. So what you're effectively looking at is it going to be a mean revision, and will the 3.7 come to dominate, or will it be the 10? Well, I would tend to think that an oligopoly, the leading oligopoly in the banking environment in Canada with international reach, will have more upside from the current levels. And remember, we're exiting a very low interest rate environment, which is not great for banks. So you put that all together, and I think it's a reasonably attractive combination.
Yeah, so I'm showing, total return 11% annually over 10 years.
And 3.7 over 5.
Right, okay. Yeah. And so, you're arguing for a return to that longer term. What about the overhang of that bank, though? They bought the Showbiz Bank they bought in LA. The people are concerned about that. They might have to put more money in, or they have put more money in.
So I think there's two big risks on banks. One is he who survives gets sued by the regulators. So whenever you have a major recession, banks are always going to get sued because they've got cash, right? So that's the first thing. But I think that the continue to tuck-in acquisition story is an ongoing requirement for banks to become better at their operations. Mm-hmm. And the US is a very big market. If they need to put a little more capital, I don't think it's a franchise killer at any point by any stretch. Mm-hmm.
Okay. I'm looking here. Bloomberg has a 5-year return closer to 11, but I won't argue with you because there may be different assumptions there. 5-year annual return. Anyway, no point getting bogged down on it. But LVMH, the luxury company, is your final idea. I saw a story the other day, though, that a lot of these luxury goods companies have unsold inventory piled up.
Mm. So the 10-year total return is 22% annualized.
Woof. On LVMH, yeah. Okay.
So you can see it's down. But I think what I would say about the luxury sector is the luxury sector tends to have consumers that weather the sector much better than perhaps lower-end retailers, right? So if you've got something like Dollar Store might be doing really well, but if you've got sort of a mid-level retailer, that's challenged because consumers are going to pull back. Whereas the wealthy who are buying the Louis Vuittons, the Hermes, and so forth, they're not too badly impacted by recession. It's a growth by acquisition story. It is obviously organic growth. You've got China coming back online, so you've got that opportunity. There's a lot of structural drivers in the business. So good execution, interesting product line that I'm probably not, the target demographic for. But I think the franchise has delivered and continues to deliver. And buying it through relatively inexpensive euro with the relative strength of the Canadian dollar makes it even cheaper as well.
Thank you very much, Darren.